Hello and welcome. You've joined us on Deal Makers. Now, at a time when India Inc. is on a wait and watch mode, the deal street has been abuzz with activity from the multinational companies which are increasing their focus on their Indian units. Now, these are multi-billion-dollar deals like the ones of Unilever, GSK, Vodafone, to name just a few. Now, India needs top dollar, and that's coming through these deals. And while one side of the argument is that some of the deals have passed the legal test, but probably the trust deficit with the minority shareholders needs to be bridged by the MNCs. And to get all sides of that topic that we are discussing today, we have an eminent panel with us. Joining us are Cyril Shroff, the managing partner at Amarchand and Mangal Das, Sunil Sanghai, the MD and head of global banking at HSBC India, and Anil Singhvi, chairman of ICANN Investment Advisors. Gentlemen, so good to have you on the show. Now, starting with Mr. Sanghai. Mr. Sanghai, you've been sitting on a heap of MNC deals. You've done GSK's open offer. You've done the ones with Unilever as well. At this time, what are the factors which are driving these MNCs to increase their share in the India pie?
Nisha, if you look at the background of MNCs coming to India, if you go back to 70s post MRTP and FERA, the number of MNCs came down to around 300. At the time of independence, we had around, post-independence, around 500 MNCs operating in the country. Now, post-liberalization, we have got around 3,000 MNCs operating in India. Most of them, barring 100, which is approximately 100 odd, which are listed in India, they are either through a joint venture or 100% owned by them. So clearly, the strategy of MNCs, unless it was regulatory required, is not to really use the Indian capital market and remain unlisted. And that's the reason why they are always looking to increase their stake and maybe even delist themselves.
Mr. Shroff, we have gone through a lot of tax uncertainties that a lot of MNCs have faced in India. But still, while we considered that India is not the flavor of the season for the top dollar companies, they are still looking at consolidating their position. What is it that you think your clients are doing at this point?
Well, the broader theme is, I think they still want to invest in India. They realize that there is a lot of uncertainty now, not just because of things like tax, but because of politics and the general business environment. But that being said, the flip side of it is that particularly for listed entities where consolidation is happening, that these are attractive valuations. And with more recent regulatory changes, there are now many more structures that are possible for them to acquire. For instance, they can now do FDI on the stock exchange, just to give one example. So the broader rationale of why multinationals are still interested in India despite all the problems is that they see an upside. I think they see that at the end of this period of a few months, when there is more certainty in terms of the economic and political strategy, that it's time to invest in India again. And you can see currently that in the India-China comparison as well, that India is a bit ahead at this point of time, where there is capital coming in and the valuations are attractive. So it's fundamentally, I think, an endorsement of the India story. This is a good time to buy and take a bet on India's future. So I think it's actually a good sign, and it's an opportunity, a small window that's available for them to increase their stake.
Right. While Mr. Shroff is saying, Mr. Singhvi, that it's an opportunity for the MNC companies at a cheaper valuation to come to India, are the minority shareholders a little circumspect about the intention with which these consolidations are happening?
Well, I won't put all MNCs into, say, one basket and give my answer, but there have been evidences last 2 years or 3 years, as Mr. Shroff rightly said, that they're taking advantage of that. And the word advantage, and what advantage going to one, obviously at the cost of the other, right?
But business is based on advantages to be taken and opportunities.
I agree with you, but now when you look at it, and it is upon the tax regime in India, and when you really look at the tax regime, not only from the point of view of Vodafone and all that, which we can discuss, but look at from the minority shareholders' point of view. When an open offer is there, or when suppose the buyback or any other situation is there, which is not through the stock exchange mechanism, but it is tendering the shares, and you got to pay taxes. So we have always debated upon that, oh, Vodafone has to pay so much of money. Look at a minority shareholder. Had he sold the shares on the floor of the exchange, he would have been exempted from 10% tax, right? We have given all sorts of tax exemptions to FIIs if they came through Mauritius, whether short term and long term, what happens to the common man? He ends up paying taxes in India.
And earlier you had mentioned, Mr. Sanghai, that a lot of them would like to delist. Now, Mr. Shroff, SEBI is looking at easing some of the delisting norms. In short, if you could explain, is it really going to tempt the MNCs to go ahead? Will it make it easier?
So it depends on what finally SEBI comes up with. But there's always been this feeling that India is one of the most unfriendly markets in the world from a delisting perspective. I think we've probably gone the other extreme in terms of complicating the whole delisting framework, as a result of which there are so many companies on the stock exchange which are not really traded and which don't really deserve to be listed. And if they had a good mechanism by which they could delist, I think most of them would have adopted that, which would be probably good for the minority shareholders if the mechanism was fair. And I think it will just improve much better governance, because there are fewer companies to track and to supervise. Let's see what finally comes out in the delisting, and we shouldn't preempt that. But I do hope it makes it easier and more pragmatic to do it, and it should be done transparently. There's a related issue also which goes to the MNC psyche, which is the squeeze out. I don't think we have that today, but part of what the kind of themes that we are seeing is, and if you took a look at the statistics that Sunil pointed out in terms of MNCs wanting to own 100% of their units. If it's only if a squeeze out were possible, that would happen, and that's going to require change in both company law as well as the SEBI framework.
Obviously, their preference would be to remain 100% owned. Post 1991, if you see, a lot of them actually have started their own 100% owned companies as well, and therefore that's obviously the preferred route. The question is
of the FERA regime.
Exactly. Now, if we can make the regulatory framework which is conducive, then in that case it becomes that much easier.
All right, on that note, I'd like to take a short break here, and we have discussed lots of issues when it comes to the consolidation by the MNC firms in India, but there are lots more to be discussed. Stay tuned for all of that right after this short break.